welcome on behalf of SEPS, and for those who haven't got the time to say best wishes, Happy New Year. Of course, we know, and that will also be a bit the subject of what we will be discussing in very strange political circumstances. We hope, let's say, that the economic circumstances are a bit more stable, and that we will see in a moment. Very happy on behalf of SEPS, let's say, to welcome Pierre-Olivier Gourinchas from the IMF, on the chief economist of the IMF, on the another department of a colleague which we have seen only a few weeks ago here, Alfred Kammer, who's dealing more with the euro area. Today we're speaking about the presentation of the World Economic Outlook. World Economic Outlook, not only Europe, of course we'll be discussing Europe as well, but looking at Europe in this broader perspective, and also interesting to see because at the moment also in Europe we're a bit too much focused or a bit obsessed on one side, but of course the world is not only one side, there are so many other parts, and we know also that these other parts, what we will see in that report, are growing enormously, and that probably we should be watching a bit more the other side, which we also know, let's say, from what Europe is now trying to do, a kind of disengage from this one partner, which is creating a lot of trouble, and trying to look at the other side and to maintain this open, kind of open multilateral trading system, which is, I think, is extremely important. But what we'll do this morning, we will have first a presentation by Pierre-Olivier of the report, and of course focusing on the global economic outlook, but looking at Europe, looking at some specific aspects, let's say where are we seeing uncertainties, but also what is the global economic outlook. And I think the important message, we may have seen it, I think this morning in the newspaper already, or we have heard, let's say, bits and pieces about it already yesterday. The economy is now not doing badly, the world economy. Surprisingly, let's say the prospects for the current year, I think, are even a bit better than the past year. So even if we read so much, there is so much noise in the newspapers or noise on the political scene, we see that the economies globally are doing well, and above all, those from, I would say, Asia, East Asia. You see where you have 40% of the world population. I mean, that's where economic growth is at the moment, which I recall. But of course, we will look at Europe. We will look at also the United States. We look at some specific aspects related to something which we as a think tank also focus a lot upon, AI, and what is the impact of AI. And we see a big impact of AI, if I remember correctly, from in the United States. And we wonder, where do we see it in Europe? Do we see effectively a problem that there is a lack of productivity growth in Europe because of a lack of attention, let's say, to this AI revolution, which apparently in the United States is causing these productivity gains, which we are probably missing in Europe. But then, of course, we're also looking forward, what this may mean, because apart from the fact that there is a good outlook for the current year, there's a lot of uncertainties also which could bring that down. And one thing which I found personally very important for Europe is that I think there has been too much, as we were discussing, too much negativity around in Europe, let's say, about our economic outlook. Of course, we have problems which we need to tackle, but it's not that Europe is in a deep economic crisis. We still had, I think, also the growth forecast for Europe was revised upwards already in August by the ECB, or was for the Eurozone, from 1.1 to 1.3. Of course, not tremendous, but again, it's economic growth. And also, if I see the current report, it's still even a bit better, I think, for the current year for the Eurozone or for the EU than it was initially foreseen. So we will be discussing these things with Pierre-Olivier, and then he will be presenting the report, and then Cynthia, or Senior Research Fellow, macroeconomist, let's say, will be going into debate with Pierre-Olivier, and then we'll have also questions from you. But we should be finished at 10 o'clock, because Pierre-Olivier has a tight schedule, as I can imagine. But you will certainly have time for questions. So Pierre-Olivier, thank you for taking the time to come here. We're really impressed, let's say, that you can do this. And also you see good public this morning at 9 o'clock in the morning, so let's say, to come and listen to you. Good morning again, and welcome, and please, the floor is yours.
Thank you.
You will have to take this microphone. And there's another one there, and then the pointer is there.
Thank you. Thank you very much, Carol, and it's a pleasure to be here and to be presenting this report in Brussels. We just released our forecast, and indeed, just let me start with the headline number. I mean, we are projecting growth that is quite steady. We're expecting 3.3% for this year, 2025, and slightly less, 3.2% next year. But really the stunning fact when you're looking at the forecast and the presentation we'll try to unpack some of this, is that if you look at the cumulated growth for 2025 and 2026, and we have 3.3% for this year, 3.2%. This is in fact slightly higher than what we were projecting, not in October of last year, but in October of 2024. So before the whole trade tensions, the whole trade war and tariffs, etc., all of this started. So in a sense, the global economy has managed to shake off the tariff tensions for 2025 and 2026, at least as we can see from the data. And that may come as a surprise because there's been a lot of discussion about how it can impact the economy negatively. And so understanding what has been happening, I think, is important, and I'll try to provide some pointers. And yes, as Carol mentioned, for the euro area, our growth projections are also slightly revised upwards. I mean, we have a growth of about 1.3% for 2026 and 1.4 for 2027 for the euro area. And that's, of course, lower than some other advanced economies like the US, but it's a growth performance that's been coming up from what happened in 2023 and 2024. So again, here the momentum is in the right direction, but of course more can be done and more needs to be done to achieve more sustainable and productivity growth and more sustainable potential growth in the region. Okay, so let me jump right in and give you a quick sense of what has been happening. So the first thing that accounts for the fact that the trade shocks may not have been having as much of an impact is that the trade shock itself was smaller, became smaller through the year compared to what was initially announced in April of 2025. The reciprocal, so-called reciprocal tariffs that were announced in April of 2025 were very elevated. But then there were a number of pauses, negotiations of trade deals, exemptions, etc. And so gradually, what became clear is that the effective tariff rate that was imposed by the US on the rest of the world was lower than what was initially announced, and you can see that on this figure on the left. The collected tariff rate, which is the blue line here, which is the one based on the actual customs data, is even lower. Again, that reflects delays in implementation, etc. So that was where we were headed. Of course, the events of the last few days are throwing that into a little bit of question. Who knows what will happen next? But at least there was a sense in which the shock was not as big. There was also a lack of retaliation. Most countries did not respond tit for tat to what was imposed by the US. They negotiated, they agreed on deals, and there was not an escalation. And of course, that was one of the big worries, that an escalation would lead to a spiral where you could get much bigger impact on world trade. So that's fact number one. Fact number two, you see that on the middle chart, the uncertainty related to everything that's happening with economic policy, not just tariffs, but also geopolitical developments, etc., spiked in 2025 to levels that were extremely elevated, but has been coming down since then. It's still elevated. It's still more than 2 standard deviations above historical norms. So we are in a regime of elevated policy uncertainty, and I think these numbers are, it says latest, but it's not as of yesterday, so they think of this as of maybe a month ago, and those numbers are likely to be higher now. But there's been a sense in which this has been normalizing somewhat. Then I'll get to some of the other drivers, but this already accounts for some of the resilience. What we've seen also is a tremendous agility of the private sector in responding to changes in the trading environment, moving inventories around. We had a front-loading, a surge in trade actually in the first half of the year as multinational corporations, businesses were reorganizing supply chains, moving things around to adapt to this changing environment. Again, that was a factor of resilience. And then lastly, financial conditions remained very accommodating. We had an environment in which stock valuations were very high, markets were willing to take risk, and that environment overall was also favorable for the global economy. Now, as you can see on the right, services also played a key role in supporting global activity, much more so than manufacturing, which has remained more subdued. And of course, that also reflects a little bit. That's where you can start seeing the effect of the tariff to some extent, because the manufacturing is where you have disruptions in production and supply chains. So now, another factor that's been quite important is, of course, the AI tech investment boom. It's been a key driver of economic activity in the US in particular in 2025. And here I want to show you some numbers to illustrate. So on the left, what you can see is if you look at the share of investment in IT, a sector in the US, relative to GDP, what you have, that's a blue line, we have levels that we haven't seen since 2000, 2001, at the time of the dot-com episode. So we have investments in IT that are at a very, very high level. Historically, they're at the highest level that we have over the last 25 years or so. This has been associated with some weakness in other types of investment, in particular manufacturing investment. That's the black line you see has been coming down. So overall investment has not been surging. There is a compositional effect with a lot of investment in the IT sector, but that has actually been material for the growth performance of the US in 2025. There is a spillover effect of that. A lot of the demand for IT, if you think about the data centers and all the demand for equipment that will go into these data centers, all of the semiconductors and all the electronic equipment, has created very strong demand for goods manufactured, electronic goods manufactured in Asia. And so you see that on the right. So even though we had, on the one hand, we had this tariffs, but on the other hand, we had this demand, this surging demand for electronic equipment. Those are the red bars on the right. Not just to actually, the red is to the rest of the world, the blue is to the US. Both of them have been increasing. So there has been a surge in demand for this category of goods, and a lot of it was coming from Asia. But what we see at the same time is an environment in which the composition of financial flows has been changing. And that's the chart on the right. The FDI has been declining overall. There is a lot less appetite for FDI, and there is a lot more appetite for portfolio flows. So portfolio flows have continued to be increasing, and we know that portfolio flows, including to the US, for instance, have been very, very strong. But FDI has been declining. That's the green line, and in particular to China. So FDI to China has declined tremendously. And some of this reflects, of course, also geopolitical tensions and risks that businesses may not be willing to take. They may be willing to invest because they can move out quickly, but maybe less willing to do FDI. Now let me zoom in a little bit more on the AI boom here and compare it a little bit to the dot-com episode. I mentioned that we're at the level of investment that we saw in 2000, 2001 in the sector. But there's been some interesting differences. So here on the left, what I'm showing you is investment to GDP in IT, and in red, this is during the dot-com episode, and in blue, this is during the current episode. Green is investment in manufacturing, kind of as a reference point. On the horizontal axis, investment to GDP. On the vertical axis is the market valuation of the sector, if you want, to GDP. And what you see there is that in the dot-com boom, we had both rapid increase in investment and valuations at the same time. In the AI boom, there's been an increase in valuations ahead of the surge in investment. So you see the line moves vertically, and then in 2024, 2025, that's when it starts moving almost horizontally. That's when you start seeing the big investment. So up until now, the market was reflecting maybe expectations of future investment and profitability, but the investments and profitability were not really there yet. But now we're seeing these investments happening. And going forward, up until now, this has been mostly self-financed. This is financed out of cash flows. These are most of the investment is coming from firms that have robust earnings. So it's not, unlike the dot-com where they had zero revenues, zero cash flows. These are businesses that are solid and are making money. But and so very little leverage, if you want, involved in financing this investment. But going forward, the scale of investments that are projected by the industry is such that it will have to rely on debt financing. It will have to rely on borrowing, and that, of course, increases vulnerabilities. Another factor, I don't know why the colors are not showing very well here on this figure, but another factor that is also been behind the ramp up in these valuations that you see there is, of course, the fact that investors have had access to exchange-traded funds. And they've increased in value, especially those that are tied to AI very strongly in the last few years. And last chart there, over there, is showing you that the amount of leverage in the industry is relatively limited as of 2025. I mean, there are some companies like Oracle that have maybe much higher leverage, but this is fairly limited. Of course, this could change, and this is a worry going forward. Now, another thing that we see when we look at our global projections is inflation is going to continue to come down in 26 and 27 from 2025. But there are some interesting differences when you look across regions. And again, you can tie some of these differences to different drivers. So if you compare the US and China, for instance, what you see in looking at PPI, you see that price pressures in the US are actually still there, and if anything, are not going away. And that again is tied to, maybe some of it is tied to the tariffs, which are increasing the cost of intermediate goods and therefore are pushing up production prices in the US, in the manufacturing sector. While by contrast, if you look at a country like China, you see a decrease in production prices. Some of it may be coming from the fact that there are tariffs, but really mostly what this reflects is the weakness of domestic demand in China that is creating a deflation-like environment in that country, and that manifests itself in decreasing production prices. Now, who is bearing the cost of the US tariffs? That's a big question. And it's a question whose answer is maybe changing, over time. But as of now, when we're looking at the data, what we're seeing, and this is what this chart in the middle is unpacking for you, is that the tariffs are mostly paid on the US side of the border. And so what do I mean by this? Well, when we're looking at how the prices are changing, we are not seeing the prices changing too much at the customer level or at the retail level. And we're not seeing the prices changing too much at the dock before the tariff is applied. So the exporters have not cut their price. So what it tells you is that in between, the distributors or the importers on the US side of the borders are the ones who are absorbing that. They're absorbing that in lower margins. That's what this figure is showing you. You see in blue, this is the let me make sure, no, green, sorry, green is the operating surplus, that includes the margin, and you see that has decreased tremendously. Yellow includes the tariffs, and so this has been absorbed in the firm's margins on the distribution and retail side. That may change over time. These firms may want to restore their margins. They may start to pass on to customers the tariffs into higher prices, so we're expecting some price pressure will not go away in the US because of that channel. And the end result of all this is that inflation differences, when you compare AEs and EMs, advanced economies and emerging markets and developing economies, have actually narrowed tremendously in recent year. You can see that on the right with inflation levels that are broadly similar. Now, when we look at labor markets, actually before I get to labor markets, still on the inflation dynamics, one of the things that has been very important in the common discussions that we, and concerns that people have is not just the fact that inflation is coming down, but concerns about cost of living and sometimes what is called affordability. And one way you can see that here on the left is you can see the increase in the price of, essential versus non-essential goods. And when we look both at advanced economies without the US and the US, you see that the increase in the price of essential goods has been larger. That's the bar in each panel, the bar on the left, than that of the price of non-essential goods. So there is a sense in which, and of course, essential goods are a larger share of the basket for lower income households. There is a sense in which for lower income households, the increase in prices has been larger than for the broader population. And that is reflected in concerns that people have about affordability. Now, when we look at wages, one of the salient facts through the post-COVID period has been some compression in advanced economies, some compression in labor income inequality. We've seen larger increases in wages for the lower deciles of the income distribution than for the higher deciles of the income distribution, resulting in some compression in the, let's say, the 90-10 ratio. This is what you see on this figure. So of course, what that means is reduced labor income inequality coming from the factors here are strong demand for workers who are essential or workers who are in face-to-face situations where there were shortages of labor supply, especially in retail and other areas. That's at the bottom end. At the top end, the fact that workers with higher levels of income were able to maybe work from home and get some amenities coming from that, allowed to have more moderated wage demands. And so that helps account for some of the compression. That's still there. But we are seeing in the US, that's the blue line, we're seeing some reversal. We're still ahead of where it was in 2019, so there's still some compression left. It hasn't gone away, but it's maybe not as strong. So now let me move on to some of the risks that we see in the current environment. So one of the risks, of course, is related to AI and the potential for a reversal. AI is a two-sided risk, and we're very clear in our when we're looking at it. We're saying both upside risk. It could deliver stronger productivity. It could deliver gains. I mean, I'm assuming most of you, all of you, are using, some LLM or some GPT model to help you in doing queries and other things. And it's, some of these things are really wonderful and they're increasing productivity, and we're all experiencing that. The question is, does it translate? Does it scale up? Not yet in the data as we can see it, but potentially it would. And so if that's the case, then that would be a world in which we have higher productivity growth. Higher productivity is good, it's increasing standards of living, so there is an upside scenario when you think about AI. And when we look at it, we think that it could generate a boost to global output of maybe around 0.3% in 2026. But there is also a downside scenario. What is the downside scenario? Well, the downside scenario is not that there is no productivity gain, but that somehow there's been a little bit of over-optimism about the profitability of the sector and the valuation of those firms that are doing all this investment, and therefore there is a correction. And if there is a correction, there will be less investment. There will be the stock prices will come down. People who are holding these stocks will be poorer. They might cut in consumption, and then there will be a slowdown in aggregate activity. So when we're looking at, that's one of the things we do at the IMF. We run all kinds of scenarios. We try to see how the global economy could respond. Here I'm showing you on the left the result of, you see all these different colors are different layers of different scenarios that we did in our October World Economic Outlook. The one I want to point to is the blue one, the equity price correction. This is trying to capture what would happen if we have a slowdown coming from, or a market correction coming from a reassessment of AI profitability. And you can see that's about 0.4 percentage point downgrade in terms of global economic activity in 2026. So that's actually also quite significant. So there is both upside risk and downside risk. One difference with the dot-com period, when we're looking at an AI correction, is that there is a lot more cross-border equity investment in the US from the rest of the world. So there's actually a lot of it coming from Europe, a lot of holdings of equity in that sector by the rest of the world. And so if there is a market correction, mechanically it will reduce the valuation of the portfolios of all the shareholders, but the shareholders are not just in the US, a lot of them are abroad. And this chart in the middle is looking at how relative movements in equity markets in the US versus rest of the world translate into changes in valuation in the net international asset position. And if you have a downside scenario like the one we studied on the left, then you can see something like it's equivalent to a transfer of wealth, if you want to think about it this way, of about 6% of US GDP from the rest of the world to the US. So that's actually quite significant. It's of course, it's buffering the shock in the US, but it's transmitting it to the rest of the world. So there are spillovers. Then the question that would arise in a situation like this, if you have a market correction, if that leads to tighter financial conditions, is would US Treasuries play their usual role as a safe asset, meaning an asset that you run to when market conditions become more adverse? This has historically been the correlation. We've seen a flight to safety going into US Treasuries. And here, the situation may be a little bit different. I mean, what we're seeing when we're looking at measures of what we call the convenience yield of US Treasuries, or in other words, the premium they earn because they're offering this safety, that seems to have eroded in recent years, especially at longer maturities. And so there is a concern, and that's a concern in the market about how the Treasury market would function in a more adverse environment. One other risk that we are flagging is that of global imbalances widening. So this is something that we've highlighted in our July 2025 external sector report, that we're seeing global imbalances, meaning the current account balances between the big regions of the world are becoming larger, more deficits in the US, more surpluses in China, more surpluses in the euro area. That's a concern because global imbalances, if they become very large, at some point there will be a correction, and that correction can be orderly or it can be disorderly, and we would all prefer an orderly correction, one that is driven by collective action from the different regions, than something that is disorderly, that is dictated by market conditions. And so you can see on the left here these growing imbalances. The size of the Chinese trade surplus is extremely high. Now, this is not the whole balance. This is just the goods trade balance, but it's really extremely high. We've heard the numbers reported, $1,200 billion trade surplus for China in 2025. The deficit in the US, as you see a little uptick there, some of it is not really related to the tariffs, but some of it is related more to the depreciation of the US dollar in 2025 than to the tariff themselves. And the expectation going forward is that this would remain also elevated. This is in the context of a very weak Chinese economy. China's economy, I mean, I say very weak domestic Chinese economy. The domestic side of the economy is not doing well. The property sector is still very, very weak. There's a lot of non-performing loans. There's a lack of confidence. Chinese households have very elevated savings rates, reflecting the lack of confidence in what's happening in the future, the lack of safety nets. So these are well-identified weaknesses of the Chinese economy that have been flagged for some time, and they create this imbalance in their growth performance that relies heavily on the external sector instead of relying on the domestic demand, and that's something that is putting pressure on the rest of the world. And not only that, but as you can see on the right, the composition of the export basket of the Chinese production sector has changed tremendously over the last 25 years. Back in 2000, the horizontal axis is a measure of the complexity of the goods that you're exporting, and vertical axis is the export share. And you can see that China 25 years ago was more concentrated in the lower complexity goods, think textiles and things like that. As you move to 2023, you see they've expanded into more complex, more advanced goods, but they haven't left the lower complexity goods. So they are across the entire spectrum. So they are representing a competitive threat to advanced economies now, but also they remain a competitive threat to lower income countries and emerging market economies. And that, of course, is creating concerns as some of the bilateral trade flows, for instance, between the US and China are being reduced. That's creating concerns about, well, where will all these goods be going? Now, I realize I'm probably running out of time, so let me know when I need to stop, but I have two more slides I wanted to show you. One is on monetary policy, one is on fiscal policy. So on monetary policy, we're coming out of a quote-unquote a good sequence. Yes, we had an inflation surge. Yes, inflation went to levels that we hadn't seen in 40 years, but central banks around the world were able to achieve a disinflation that was A, very rapid, and B, without a recession. And so that's a rare combination and it should be duly noted. Inflation expectations, when you look 5 years out, remain very, very well anchored. But of course, coming out of a high inflation episode, you have to ask yourself whether, if inflation were to come back, whether these inflation expectations would remain as well anchored. And so that's something that I think central banks are looking at carefully. A second thing to note is that the environment is, we have all these different forces playing out, and some of them may change what is called the neutral rate for central banks. This is kind of like the pole star and North Star by which they should guide their policy, thinking about the rate of interest that would be the one that is relevant and that they should try to aim to achieve. And here I want to flag in this middle chart that there are different forces playing in different directions for different regions of the world. In the US, the AI boom, the prospect of higher productivity growth and investment increase, lower savings, all of this would be pushing up the neutral rate, meaning that central banks, in order to keep inflation stable, would need potentially, if the neutral rate increases, would need to increase their policy rate. So that's what you see with this bar here in blue. In the euro area or in China, the threats to the loss of competitiveness in the euro area or the potential growth slowdown in China, all of these things would go in the other direction, would tend to decrease the neutral rate and therefore put downward pressure on what the policy rate, what the appropriate policy rate should be. So if you translate that into policy action, that's on the right, what you see is that, and these are not baselines, they are just when we're thinking about those risks, whether the slowdown in China or we think about the AI boom, there is a risk that monetary policy could be overly easy in the US. And you can see the range with the little black bars there of what the policy rate would be under these scenarios. While on the opposite side, in the euro area, there is a risk that the policy rate could be overly high, given the decline in the potential decline in the neutral rate. Finally, on fiscal policy, because that remains a big concern, although we were discussing this earlier, it doesn't seem to be top of mind for at least business executives who are meeting in Davos this week. One of the things that we see is there's been a weakening of fiscal discipline in many countries, but even more so in advanced economies than emerging market ones. So the left here is showing you estimates of the responsiveness of the primary surplus to increase in public debt. Now, if you think about what the logic for this is, if you have an increase in public debt, in order to stabilize, you will need to increase your primary surplus to just stabilize. You may want to do more in order to bring it down, but at least you need to increase it enough to stabilize it. And you see these estimates from pre-COVID to now have decreased in most countries, and even more so for advanced economies. In other words, if I translate, it means governments are less responsive to increasing debts in terms of stabilizing with primary balances. And if they had used the same fiscal rules, implicit fiscal rules as before, in other words, if they had remained as careful about fiscal discipline as they were before, then public debt levels in advanced economies, G20 advanced economies, would be between 1 and 8 percentage point lower relative to GDP, points of GDP, while in emerging market economies with between 0 and 4%. So this is quite sizable. This slippage in the fiscal discipline has implications. And the last graph is basically showing that when we look at low-income countries, there is also a very significant shift in the share of borrowing and the currency in which countries are borrowing, with an increased borrowing in RMB versus borrowing in dollars or in other currencies, which of course also creates some risks. If you have some major adjustment in the value of the RMB relative to, say, the dollar or other currencies, then these countries could face headwinds going forward. Let me stop here.
Thank you very much for this very interesting presentation. I would like to engage a bit in a conversation and ask you a few questions on the key messages that you gave us. And then, as Carol mentioned, I would like to open the floor for questions, so just think of a few of them. Let me start with your first point, which is about growth. If I go back 1 year, so beginning of 2025, I'm not necessarily in the business of forecast, but basically my expectation was a much weaker global economy and US economy than actually we saw. Indeed, forecasts actually have been revised during 2025, and now we expect 3.3, which is, I mean, it's a good number if you think in terms of the uncertainty that we have. How should policymakers actually read this number, given all the uncertainty that we have? That would be my first question is, okay, we are fine, we shouldn't do anything.
I don't think that we are fine, and I don't think that we shouldn't do anything. If I go back to a year ago, actually in January of last year, the narrative when we released our report was, at least from our perspective, a bit different from the one you mentioned. The expectation then from the markets and from a lot of analysts was that the US would launch a large deregulation effort. They would implement expansionary fiscal policy. And these two things combined would deliver substantial growth in the US. And so I think there was this view, and yes, maybe there would be something on tariffs, but I don't think that was what everyone was expecting would be the primary tool. And so there was, as of January of last year, there was a general view that the US economy could be doing well, both as a combination of deregulation and fiscal policy. Then, in April, when the US administration announced its tariffs against most countries in the world, I think there was a big reassessment. And that reassessment at the time was, well, okay, maybe the effort will not be on deregulation. Maybe the effort will be, we'll have to see what happens on fiscal. All of a sudden, everything was about trade, was about disruptions in supply chains, in trading relations, in changing world order. And there was a lot of anxiety at the time. And I think gradually over the year, as I illustrated, there's been a reassessment of how much damage would be done by the tariffs, how big the tariff shock was going to be, and how much damage it would be doing. So we are back now to a forecast when we're looking at the US economy where there's been some damage from the tariff shock. And I should be clear also that the damage we see is only the beginning. The tariffs, if they remain at this level, are likely to have an effect that compounds over time. But we see these other factors. The fact that the budget bill, for instance, has allowed much more rapid depreciation of business investment, the expansion of the tax cuts, the drive into pushing digital investment in digital technology, in AI as well. All of these things are basically driving the narrative right now. So should we just relax and say no? Why? Well, because we live in an environment in which we realize that we can have these large changes in policy that are can have very material effect. And the fact that there was some resilience in the past, I don't think is any guarantee that the private sector will be able to adapt if there are more disruptions. If there is an escalation of trade tensions, I think it's very unclear the extent to which this will basically have little or no effect. I wouldn't be so sure.
Let's move maybe a bit more on Europe, and just to pick up on your last point. I mean, of course, what we heard from the news over the weekend and this increase in geopolitical tensions about Greenland and the prospect maybe of new tariffs on certain EU member states is certainly creating some concerns in the European economy. Carla mentioned at the beginning, in the end, we are doing a bit better than expected, but there are some vulnerability. Do you think another potential trade shock could put at peril actually the European growth? Or,
well, certainly, I mean, so as a whole, the euro area is doing, each country in the euro area is doing a lot of trade, but it's also doing a lot of trade with other countries in the euro area. If we look at the region as a whole, of course, it's open. But like any large region, it is probably reliant also much more on internal trade. And so the first level of response is that, and that's something that has been well identified in a number of reports, etc., is there are ways for the euro area, the European Union, to be more resilient, and they rely on things that can be done internally. Completing the single market, the savings investment union, making sure that the productivity gains can be achieved from better integration. I think these are things that would be good no matter what, and they become must-have in an environment where the external environment is more challenging. There are not things that can be ignored anymore if you cannot be expecting to have as stable trading relations with the rest of the world. Now, on the trading relations with the rest of the world, the interesting things is that Europe is, in a sense, is connected both to China and to the United States. It's a major source of, China is a major source of imports, and the United States is a major source of exports. So that's the first order picture. So the US is a very large market for many European economies, Germany in particular, but not only. And China is, and Europe is a major market for China. So that gives Europe also leverage on both fronts, but with leverage comes vulnerability. And so that's what I think has to be managed, and has to be managed very carefully. Now, from our perspective at the IMF, what is really important to us, because I think the evidence is really extremely strong, is that the open trade environment that has been built over the last 80 years with clear rules that guide trade, both rules of the road, but also dispute resolution and all of that, which are not directly in our mandate. I mean, a lot of that is World Trade Organization. But these things have been critical for the growth of the world economy. And so we want to make sure that they're going to be preserved. And of course, we're looking at the developments that we're seeing with a certain amount of apprehension, because we're thinking that there is a risk that they will dismantle the world trading system as we've known it, and the question is what then comes next. And so we always call for resolution of trade tensions, resolution of trade disputes, and also a very pragmatic approach to developing and furthering trade relations. So some of it, as I mentioned, can be between countries themselves inside the European Union or the euro area. Some of it can be with other countries with which the European countries can develop, find mutual agreement. And this weekend, we talk a lot about the developments related to between the US and the euro area. But the other big development was signing of Mercosur, and I think that's certainly a very big development that represents 700 million people. That represents 20% of world GDP. So this is really an important development.
This really, I think you touch upon a point which is really crucial, and is the internal dimension of trade within the EU and the external dimension. And we have been in Brussels complaining for years about the fact that actually the single market has never been fully exploited, if you want, even on trade, despite the introduction of the euro. And I think one of the reasons for this is that globalization, I mean, all the trends and development in globalization went in parallel with the creation of the monetary union, and the fact that we had global rules basically applying on a much bigger market, maybe offer to European companies opportunities on the global scale and not necessarily on the EU scale. Now, I mean, of course, the context is changing a lot, and we are seeing a lot more risks outside the EU and more fragmentation. So there is really this question about whether turning domestically can compensate or can maybe mitigate some of the losses that or the risks that we are going to see on a global scale. Do you think this is going to be enough or can make a difference?
Well, I do think it can make a tremendous difference. I mean, as the Draghi report, for instance, I think illustrates very, very clearly, one of the big issue for the European Union in general has been the decline in productivity relative to the frontier relative to the US, not over 2-3 years. It's not about the latest numbers. Yes, the productivity numbers are good for the US right now, but there's a lot of volatility in the year-to-year numbers. But if you take the longer picture, you look at 2000 to 2025, it's very, very clear. And that should be, and that is a source of concern. And so finding ways in which, in a sense, economies of scale can be realized. And when I say economies of scale, it's not about creating European champions or things like that. We're always very careful when it comes to industrial policy. But I think, in particular, when we think about innovation, when we think about the ability to scale up, having access to capital for innovators who have good ideas and find themselves in a situation where it's sometimes difficult, and so what they do is they move to the US, they move to Silicon Valley, where they can get access to venture capital. Those things are things that can be addressed, can generate tremendous value in the European Union. And so they can help close some of that gap and build on the tremendous, I mean, Europe is a region with tremendous human capital and tremendous amount of capital. So the two Ks are already there. It's just a matter of mobilizing them and making sure that some of this innovation can be scaled up in Europe itself.
Maybe my last question before I open the floor is really related to this. So you spoke about the productivity gap that we have in Europe relative to the United States. I mean, quite a bit of it is related to this sense of lagging behind the United States, but also China, in fact, when it comes to investment in AI. What do you think can make the difference? I mean, it's all about investment, policy, human capital. What actually can, what combination or what mix can really help Europe making a step forward when it comes to productivity?
Well, so I think the comparison with China is interesting because our studies show that when you look at industrial policy in China, and of course there is a lot of industrial policy in China, our estimates are that this is upwards of 4% of GDP in terms of subsidies, so very, very large, much larger than anyone else. You can point to technological successes associated with that. We can all think about the Chinese EVs, or we can think about progress in particular industries. But if you take the broader picture and you look at overall total factor productivity in China, it's been actually pretty bad. So there's evidence also that there's a lot of misallocation of resources that comes from industrial policy that invest resources in some sectors. Those sectors can be, the targeted sectors can be doing well, but the untargeted sectors can be doing much worse, and the average can actually not be so great. So I think we should be careful about wanting to translate the Chinese industrial policy model on the European stage. I think the broader message here should be that you want to let the private sector make the investment decisions as much as possible. So you want to make sure that they're allowed to invest at scale, they're allowed to make those kinds of decisions without necessarily impediments. I think that proposed 28th regime, for instance, goes in that direction. It allows businesses to be able to operate in more countries, to be able to scale up, but not necessarily directing where the investment should be going, and even worse, in which companies it should be or which firms it should be going to, because that, I think, is the historical record on this is not particularly good. So just clearing the stage, making sure that private investment can operate, and of course within a regulatory framework that controls the risks, etc. It's not about a laissez-faire environment, but just making sure that we remove some of the barriers to scaling up.
Thank you. I'm now opening the floor. Anyone who would like to ask a question? There is a microphone. There is the lady at the back.
Thank you. Do you want me to stand up so you? No, I can sit.
You introduce yourself.
I'm Megan Richards. I'm speaking in my personal capacity. I wanted to ask you about services as opposed to goods. As you've said, also the impact of tariffs has possibly been less than we expected for a whole series of reasons, partly also because services are such an important part of our economies now. And I'm wondering what you think of, this is a very politically incorrect question, if countries were to retaliate against tariffs on goods by increasing, for example, digital services taxes or other impositions on services, would that have a negative effect, or do you think this would be eventually absorbed as the tariffs on goods so far have been?
Well, any form of tariff is going to hurt both parties. I like to say that there are no winners in a trade war. There are only losers and relative losers. So certainly imposing any form of tax on digital services, etc., is something that would be hurtful in the European for the European economies who are dependent on some of these services. So that's a decision here that goes beyond economics. So it's beyond my remit. But just on the economic side of it, it's very clear that it would have a negative effect.
Another question? The gentleman at the back.
Yeah, I'm Robert Coleman, University of Brussels. Thank you very much, Pierre-Olivier, for this really tour of force in describing the world economy. Can you perhaps comment on the role of AI for emerging economies? Academic discussions like SMO, Aguillon focus a lot on the US economy and perhaps Europe. So what specific challenges do the emerging countries face? Given the AI revolution, will AI help them or not? And also a related question on the emerging countries. So China's trend growth is falling gradually, but this is compensated by the fact that India now is growing faster. How do you view what's behind the Indian growth miracle, and is it sustainable? Is it going to last a decade or two? What are your forecasts on that, please?
Yes, on AI, and nice to see you, Robert. On AI, we've looked at, so there is a question of preparedness for a lot of emerging and developing economies when you think about AI, because it's not like AI is happening in a vacuum. It requires infrastructure on the physical capital side. The capacity, the bandwidth for internet and everything, so that you can actually have access to this. It has implication in terms of energy, and it has implication also in terms of, you have to look at the structure of the labor force also to think about where the demand might be coming from, and more importantly, perhaps, whether that's going to substitute or complement existing skills of the labor supply. So that's something, especially on the preparedness, at the fund, we've put together an AI preparedness index that looks both at and there is a third aspect, which is legal environment, legal structures, and so we try to quantify and measure for each country the degree to which they were ready for AI, and there is a huge variation, and of course emerging markets and lower income countries are further behind many of them. Then the question of exposure for the labor market, what we find is that in fact exposure is not as high as for advanced economies, because there is a much higher share of, it's very simple, a very much higher share of the population is working in, for instance, the agricultural sector, and the agricultural sector is not directly exposed to AI. It's more sort of clerical positions. And within those who are exposed, the degree of exposure is about similar to the one you see in advanced economies. So we've done some scouting a little bit the landscape and trying to understand which countries and what countries need to do in order to prepare themselves for AI. We've looked also at the skill composition. We have just a report that came out actually a week ago that looks at what we call a skill imbalance index, which whether your labor force has skills that will be in demand as AI gets deployed, or will actually become obsolete, and we try to quantify that as well. On your second question, on China, yes, we are seeing this decline in medium-term growth. We're actually projecting 3% or slightly above 3% as potential growth, which is significantly below where they are right now. And that is not just the demographic slowdown in China. That some of it is really related to the fact that we anticipate smaller productivity growth going forward. And you're right that India has been doing very, very well in recent years, I mean, posting growth rates of 6-7%. Now, India starts from much further behind. So India can benefit from what I would call the standard neoclassical convergence catch-up dynamics, much more so than a country like China at this stage. They are not facing the prospect of a middle-income trap. They are far from the middle-income trap, and so you're seeing some degree of integration in the the Indian subcontinent was also very fragmented in terms of economic integration. Some of this is being reduced, and that unleashes some convergence growth that is of course very welcome. So we expect the dynamics to continue going forward.
I think that there is another question here.
Marie Gourmand, Financité. Will the American dollar remain the dominating currency? That's my first question. The second question, should central banks remain independent?
So the answer to the second one is a resolute yes. Central bank independence, there is no question about it. It's one of the things that has allowed I mentioned the disinflation without a recession. That has been allowed by the fact that central banks were credible. So even when inflation were reaching 7, 8, 9% in some countries, you were asking people, what is your expectation of inflation 5 years out? And their answer was 2%. And why is that? Why would they expect 2% when inflation is closing on double digits? Well, because they trusted central banks to be able to achieve that. And central bank independence is critical for having that credibility. If that is gone, it's very hard to see how you can build that credibility if you have interference in the monetary policy decision process. It doesn't mean that central banks are free to do whatever they want. They have a mandate. Their mandate is coming from elected bodies, it's coming from governments, etc. The 2% target is not something they are free to choose for those central banks that have a 2% target. But deploying the instruments to achieve that, that's where the independence is absolutely key. So that is an easy one. The first one is, in some sense, also easy. When we look at, part of our external sector report in July 2025, did a deep dive on the international monetary system and how it has changed over the last 80 years. And the striking fact is how dominant the dollar remains in all dimensions, all financial dimensions. And so, you look at bond issuance, you look at reserve holdings, you look at the currency to which countries tend to peg when they are trying to regulate the fluctuations in their exchange rates. You're looking at trade invoicing, you're looking at transactions on foreign exchange market. Across all these dimensions, the dollar dominance is there and hasn't really changed very, very much. Now, we can always speculate about how things might change, but we're starting from a position which is a position of absolute strength. And the next currency is a very distant second, and that's the euro, of course, and then there's a distant third, and that's the Chinese RMB. There have been some changes in terms of trade invoicing and things like that happening with some of these other currencies, but it's still very, very marginal. So I don't think there is any immediate concern. But of course, it operates in an environment in which that dollar dominance is something that is benefiting also other countries in the world in terms of providing, a unified integrated financial landscape. So financial fragmentation, if it were to happen, would be a much bigger deal, in my view, for the safety and stability of the global economic system than what we've seen on the trade tension side. And I think everyone understands that.
I think we need to close because we have reached, 10 o'clock. I just wanted to say I very much agree with your last point. And thank you very much for helping us to navigate this great uncertainty in which we are today, driven by these multiple policy and political shocks, but also these underlying transformations that are really reshaping the economy. This is not really the last word, and we will have a lot of updates, but many thanks for sharing your thoughts and your knowledge, and read the wheel, the update of the wheel, which has been published yesterday. And now there are many more regular updates of the wheel. Remember when there were 2 publications in April and October, if I'm not mistaken now, a few more.
Yes, we still have the 2 regular updates. That's the full World Economic Outlook, and we have, those are the World Economic Outlooks, April and October. And then we have 2 updates, one in January, the one that was just released yesterday, and one in July.
So quite a lot of reading. And thank you very much for joining us, and have a nice day.